G'day folks, welcome back to another update for natural gas. Now the chart is showing a bearish momentum with a retrace still in play, bullish divergence still in play. We'll include backtesting, so don't forget that like and subscribe button to support the channel. In terms of the outlook, as of today, April 22nd, AI demand impact, surging AI data center energy consumption is increasing overall electricity demand, particularly in the US and Asia. While much of this demand is met by renewables and nuclear, natural gas remains a critical backup and balancing source, especially during peak loads and intermittent renewable supply. This is supportive of long-term natural gas demand, but the effect is moderate and not yet fully priced in due to rapid advancements in energy-efficient AI infrastructure. In terms of geopolitical events, tension in the Middle East and Russia-Ukraine continue to create supply uncertainty affecting LNG exports and global trade flows. Europe's pivot away from Russian gas increases reliance on US LNG, tightening US inventories and supporting prices. Recent US policy actions restricting new LNG export projects have added to market volatility as future supply becomes more uncertain. So we always start with long-term trends, and for natural gas on the monthly, it's broken above the moving average band, giving us a bullish momentum, likewise the CCI 150. But notice we had a very bearish candle so far this month, and it's a bit of a pullback at the moment. On the weekly, it's broken down below those moving averages, below the CCI 150 and also below the price chart moving averages. So that's giving us a bearish momentum on the weekly. And of course on the daily, we've also been in below those moving averages. We've also got this new CCI 1500 indicator, and that gives us an overall trend in terms of trading on the intraday time frame. So if we go to the 1 hour time frame as an example, we look at the momentum as well and the trends. So again, we take predominantly short trades based on the daily if you're trading on the 1 hour. And you can see here, it's actually broken down still below the moving averages. It's currently in that little moving average range of the CCI, but nothing really to quantify any bullish momentum yet. And if I put in some trend lines there, you can see there it was hovering below that lower diagonal descending trend line. And in our last video, we did draw this double bottom on the CCI versus lower lows on the price, and that failed to bounce. And as an effect, the CCI went pretty much slightly rised, or even actually went sideways. So what I'm going to do now is move that to that point there, and I'm going to get rid of that initial. Remember, we don't trade these bullish divergence. We've got a bullish divergence there, that long-term one over those few days since the start of the month almost. And we take that back as well. So we extend the price chart, and we'll take that, get rid of that one. And we'll extend that back probably to that point there. That coincides there. So again, higher lows on the CCI versus lower lows on the price. Now I'm not going to draw a target for this yet. I'm going to remove that. So that target's now fallen further to the downside. We don't trade long here. That's very dangerous because we're still in a pretty strong downtrend. So we wait for this to either play out, to bounce and hit that. If I was to draw a minimum retrace on this one, I draw a Fibonacci from that low. We'll take it back to that high. So the minimum retrace will sort of correspond with this diagonal descending trend line, that 38% level. I'm not going to draw a target range in there yet, but that's what we anticipate if it bounced from there. Of course, this could still go further to the downside, and as long as the CCI keeps rising from here or going sideways, higher than that point, we're going to consider this a bullish divergence. So I'll keep that in there for the moment. So what I've got here, first of all, is the back test, and I've got it starting here for the stop loss approach and the average down strategy. They're starting on this one based on the daily, going long during this period, and that's why I've got this CCI 1500. It gives you a nice clear momentum, if you like, or trend, as opposed to the CCI 150, which is a lot more erratic and volatile. So this gives you a smoother line. So you would have been going predominantly long during that period, and you would have stopped going long at that point there when it started turning down, and that corresponds with this period back there. So you can see there on the, about there roughly, on the daily chart, when it started breaking to the downside, you would have made 4,100, around about 4,100 on the stop loss approach, and about 5,360 on the average down approach. So again, always stop this out whenever this higher trend changes to take your profits. Now, if we go to the short positioning, you would have started taking short positions from that point there, when the CCI and the price broke below the moving averages, but also when the CCI 1500 started trending downwards, and that's indicated by this period here on the stop loss and the average down. Now they both entered similar number of trades, but no averaging down on the average down strategy. But you can see here the stop loss approach, because of the stop loss method, has actually gone below our baseline of 100,000. So you're actually losing almost $100 on that strategy, whereas the average down approach, you'd be up about $1,700 if you're going short, beginning back there. And again, the strategy is when the CCI is a fresh breakout from the moving averages, and likewise the price is also below the moving averages as well. So for BOIL on the monthly, it's still very strongly bearish on the price chart. There's no CCI for it. On the weekly, likewise, it's broken below the moving average of the price chart. But notice the CCI 150 was showing a bullish divergence, and that actually bounced off that moving average range. So that was a initial bounce. But now currently we're probably breaking into a bit of a downtrend at the moment on the CCI as well as the price. So just be cautious of that. I would call that probably a bearish momentum at the moment on BOIL on the weekly. On the daily, it's been now bearish for some time now. It's broken below the price moving averages as well as the CCI. Notice our CCI 1500 indicator here has been trending in a negative or a bearish momentum. A couple of bullish momentums there, but again, I'll show you the backtest of those in a moment. But at the moment, we're still predominantly bearish on the CCI 1500 as well as the price and the CCI 150. If I put in the trend lines there as well, you'll notice here it's bounced off that support at 35.98, and it was fluctuating in that range between those two diagonal trend lines, and it's actually been breaking below that. So at the moment, again, still bearish on the daily. If we go to the 1 hour time frame, again, it's taking predominantly short trades only. I did draw this bullish divergence in our last video versus lower lows on the price, and I draw a target range for that. Now you'll notice again, similar to the natural gas commodity price, the price fell further and the CCI kept rising, which means we have to then realign that target range because it's no longer valid. So what we do then is we extend that trend line to there and extend that trend line to there. So that's showing us now it's still a bullish divergence. And again, if I was to draw a new target range, which I won't do because it's hasn't really started to develop yet, once that breaks up, especially through that moving average range, we expect it to hit that 23-38% range. As for the back test, again, we've got the stop loss approach up here and the average down approach, and this is going short predominantly. And we've started the back test here when that bearish momentum started back here around the 9th or the 8th of October 2024. So you can see there the stop loss approach. We would have stopped it at that point there when that CCI 1500 broke into a bullish momentum, a very slight bullish momentum. So that would have been around about this point here. So the stop loss approach was returning about $196 if you were trading $1,000 lots on shares, and the average down approach was generating about $593. I'll demonstrate the bullish moves in a minute, but then had we stayed in the trade, then again you would have started going short around this period back here. So had you stayed in the whole period going short, the stop loss approach has generated $350 and the average down approach has generated $936 with a couple of average downs in those points there. Now if we go to the bullish movement, and that would have happened back here when it turned bullish on the daily, that's indicated by these two periods here on the 1 hour time frame. Again, the stop loss approach stopped out with a bit of a break below the break even, and you would have definitely probably stopped it once there, and that would have been without any trades, gone in again there, and then you would have stopped it out again about there. So you probably wouldn't have taken these trades, so you would have just taken that one trade there. The stop loss approach, you would have been in negative by about $50 odd, and the average down, you would have been up about $30. So if you were trading $1,000 lots, and you would not have gone long during the rest of that period. As I said, you would have been taking short trades only. For KOLD, on the monthly, it's broken below the moving average range, giving us a bearish momentum. There's no CCI for on the monthly. On the weekly, it was bearish, but notice the price is now approaching that moving average range, and the CCI has already broken through its moving average ranges, giving us a slight bullish momentum. although I'd call it neutral because we want to see this break above the moving average as well on the price chart. On the daily chart, again, we bounced off this minor support at 1621. We did have this bullish divergence, and we drew a bearish momentum here on the price chart versus that bullish momentum, and that's actually started to bounce, and we've drawn a target range there, and that target range is indicated by the Fibonacci going back to that level. It's a 23-38% range. So that's our minimum target, and it looks like it's on track to hit that range. So a few things can happen. It can actually hit that range and then bounce further to the downside, or it could actually keep rising. We can't tell. We have to play one day at a time, but at the moment it looks like it's approaching that minimum range. So if we go to the intraday chart, again taking predominantly long trades at the moment based on the daily, but notice also on the 1 hour chart we've got a bearish momentum, a bearish divergence I should say. Lower highs on the CCI versus higher highs on the price, and that's a bearish divergence. So again, if that starts pulling back from there, we expect it to break down. Now I'll probably draw a very narrow Fibonacci retrace. I typically take it back, assuming it starts pulling back from that high, I'll take it back to the low before the divergence started. So that'll be the range there. So very minimal drop if it was to pull back as a minimum. Of course, it could go a lot further, so we play it 1 day at a time, or 1 hour at a time in this case. It's an hourly chart, so I'll see where it goes. So first looking at the back test with the stop loss and the average down, this is going short. We started the short programming from that point there when it first started turning down on the 21st of November, and that's where these two back tests have started. So the stop loss approach, so we would have stopped it out on the first indication there when it started going long. So let's say we stopped it at that point there. The stop loss approach would have generated $273, and the average down approach would have generated $329. So again, always stop it out whenever you see a change in direction on the CCI 1500. You can see there as well on the price and the moving average of the CCI, it started breaking higher. So ideally you want to follow either one of those approaches, either this CCI 1500 or the CCI 150 when it does break above the price and the moving averages on the CCI. Now if we go to the long positioning, assuming we take long positions from that point on the daily, on about the 27th of March, that's indicated by this period, you would have gone long, and both have returned $87 so far. But again, just be mindful, we've got a bearish divergence at the moment on the 1 hour time frame, so we might see a bit of a pullback in the short term. So now looking at UNG on the monthly, it's broken down below the moving average of the price chart, giving us a bearish momentum, but notice the CCI 150 is still above its moving averages, so I'd call that a neutral positioning. It's uncertain which way to go, so we'll just keep that in mind. Now we look at the weekly to sort of give us a bit more clarity. On the weekly, it's broken below the moving average of the price as well as the CCI 150, giving us a bearish momentum, so bearish movement on the weekly. And on the daily, that's already broken below the moving averages in alignment with the weekly, and our CCI 1500 is giving us a bit of a late start, but a break to the downside as well at that point there. We did have a bearish divergence there. You'll notice that lower highs on the CCI versus higher highs on the price, that was our minimum range. I pulled it back to the Fibonacci at that level. That was a 23-38% range, and it's fallen right down near the 100% retrace level so far. Now if we go to the intraday chart, seeing so we're taking short trades only at the moment, but you'll notice here we've got a bullish divergence, higher lows on the CCI versus lower lows on the price. And again, that's very early in the stage. We might see further declines on the price. So I'm not going to draw a target for it yet, but if I was to draw a target, it would go from that low up to probably that high there to calculate the 23-38% Fibonacci range. So bullish divergence at the moment. Looks like it's about to start. Of course, it could go further. Now, if we look at the long back tests, and these back tests have started back here on the daily when around about the 10th of December 2024, the stop loss approach and the average down approach. Now notice a bit of a thing here to be aware of. The CCI 1500 down here has given us a late start to go short, whereas the CCI 150 and the price have broken below the respective moving averages around this period. So that's where you ideally would have started going short, around this period there. So in terms of going long, you don't just look at this in isolation, you also measure any breaks to the downside on the price and the CCI. So for example, looking at if you had gone started going long during this period, you possibly would have closed out your positions if you're in profit at each one of these stages when it hits the moving average. Let it go until it hits the moving average again, but definitely close it out when you see a negative like it is back here on a daily. So you would have closed it out there and then reopened long positions again at that point. Now this one had a bearish divergence, and that would have been a definite signal to close your long trades, and you possibly could have started going short. That might have been a bit too early there, because what you want to see, you'll notice the difference between that area and this area. Those moving averages, the blue moving average is below the red moving average, whereas here the red moving average is still below the blue, and the prices and the candles are above those respective moving averages. So you want to see a bit of a confirmation and a break to the downside, so you possibly could have started going short during one of these periods around here. And that's, so again, closing it out ideally, just first to close out the long positions. Whenever you see this break to the downside, and especially when you see a bearish divergence like at that point, and that would have lined up somewhere around this period here. So even though you got a couple of positions opened, the stop loss approach would have generated $377, and the average down approach would have generated about $316 odd as well. Now in terms of going short, again we would have started somewhere around this period there, and that's indicated by the stop loss on the average down approach here. And during this period you would have let it go, and you might have closed it out when it hit that daily moving average on the CCI. But had you let it go, you see that you fell a bit below the break even on the stop loss approach and also on the average down. But had you, and you'd still be in a trade today, but again, take note of the bullish divergence. So you might want to take your profits off the table whenever you see a divergence and let it play out. But so far the average down approaches, the stop loss approaches generated $54, and the average down was generated $139 had you been trading $1,000 lots. So if you're new to trading, we are now including a weekly video series of Pete's Investing Plus One as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content and help keep me motivated to keep doing these videos, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Think of it as sitting down with me over a cup of coffee. Thanks, and talk to you in our next video.